Hi everyone, welcome to another weekly Friday chat. It's a June edition, and we're going to be talking about why we do nothing. Stay tuned. All right, so no, I'm not talking about Seinfeld, the show about nothing, although I could do an episode every week about Seinfeld. It's probably my most favorite TV show ever, at least comedy ever. It's not a show about nothing.
It's about nothing.
But what I wanted to do was, in light of, the debt ceiling, the budget passed for that. So we've kind of averted that issue. And I just got done with my wrap the month video for May, which hopefully a lot of you watched or you're going to get to watching it. The link for the video will be in the show notes on the bottom here. But I kind of wanted to stick with a few themes and a couple conversations that I had with clients over the past couple of weeks about, they were concerned about the market and issues going on, rightfully so, debt issues, debt ceiling, what happens if we default. Like I said, we've averted that, but kind of a more philosophical reason as to why we manage money the way that we do. And so it got me to thinking, why do we not, when we know that there's stress levels in the market, like the debt ceiling, like the budget vote, we kind of knew, or it's pretty easy to predict that, the month of May or the last couple of weeks of May, at least, we're going to be choppy, was going to be rough. So what a lot of clients ask, and I ask myself too, and it's a great question, is, Joe, why don't we just sell out and then get back in? So there's a couple of reasons for that. The first reason is it's but it's much easier to figure out when to sort of sell to get out. But if we want to stay invested and we want to have our money grow and outpace inflation and provide the paychecks that we need in retirement, we need to stay invested to outpace inflation. The tricky part, it's almost impossible to figure out when to get back in. And a couple of examples are, if you remember 2008, the S&P that year was down almost 40%. We had banking issues, financial crisis. People were scared. People were taking money out of banks, putting money under their mattresses. We literally thought the whole financial system was going to crash.
If the financial system collapses, it will take every one of you down.
2008 was brutal. The fourth quarter was even more rough than, at the other three quarters. And then in March of 2009, the market basically reversed itself and did nothing but go up until last year, 2022. And here's a really interesting stat from Fidelity, and we've seen these charts before. Pretty much every major investment research firm puts it out here, but it kind of tells you that if you're out of the market on some of the best days, it dramatically affects your rate of return and your performance. So when we look at the chart here, this chart is showing us a hypothetical growth of 10,000 invested in the S&P 500 in January of 1980. If you missed the best 5 days of the market, it was over a $400,000 difference. So meaning, if you took your money out of the market for those best 5 days, that 10,000 would have grown to only 671,000. If you'd have kept it in during the best 5 days, you would have had over $1 million. And the examples just get even greater. If you would have taken your money out during the best 10 days, you would have only had 483,000 compared to over $1 million. The best 30 days, 173. We can kind of see where we're going with this. So when you kind of look at these things and we look at it academically and we're in the right stuff and right things, it's very warranted. And I totally understand, the thought process behind, Joe, let's just sell out and get back in. But it's really never been proven to work. Maybe in the short term, but over a 10, 15, 20-year period of time, I've never seen anything academically that has proven that trying to time and get in and out of the market actually adds value. If you're doing it in taxable accounts, it adds a lot of taxable events. So it's really not that tax efficient. So there's a lot of different reasons. Okay, so what I also wanted to show you was an email that I get at the end of every business day with how the stocks that we have in our portfolios, these are all of my watch list, all the different things. I get about 10 of these, so I'm not going to show you all 10. But what I wanted to show you was on June 2nd, the email that I got for for a majority of the holdings that we have in our portfolios, kind of what I was talking about before when you're talking about being out of the market, missing kind of the big moves. Well, this is Friday, June 2nd. Why did I pick Friday, June 2nd? I picked it because that was the day that Congress approved the bill to raise the debt ceiling, and it was going to the president for him to sign off and approve, which I believe he did on Saturday. But anyway, everyone kind of assumed and thought, since the House approved it, Congress approved it, that the debt ceiling was going to be raised and the crisis averted. But when you look at this, look at some of these rates of returns for some of our stock investments that we have. So our small cap fund was up over 4%. Another small cap fund was up over 3%. Our S&P 500 equal weight was up over 2%. Our high yield was up 2%. Our dividend appreciation was up 1.79. Our total stock market, our international stocks. I mean, when you look at something like this, such a huge swing, this is why it's really hard to time and figure out when to get back into the market if we were out. Because on this day, we would have definitely still been out if we were trying to time and trade around the debt ceiling issues, because it wasn't approved yet. It went to Congress that day during Friday. It got approved then, and then it was going to the president. So you wouldn't have enough time to kind of figure that out and get back into the market that quickly on Friday, even if you had the gumption to do so. So if we were not invested on that day, we would have missed all these huge run-ups. And that's my point before with the previous chart, is if you miss 5, 10, 15, 20 of these days over a 10-year, 30-year period of time, it's going to have a dramatic impact on your overall rate of return. All right, well, that's a wrap on another weekly Friday chat. Just kind of wanted to, I know it was kind of random with my thoughts on how we do different kind of things, but I was thinking about it during the week, but I thought I wanted to share it with you. Hope you enjoyed it. It's Fridays, it's pizza. My shirt says pizza and chill, but you can't really see it. It's Fridays, it's pizza. Enjoy it. See ya.